Good morning, investors. Happy Tuesday. Today, I got three pretty good stories that came out last week regarding GDP, which is the gross domestic product index that the U.S. Generates. It's basically how we know if we have a healthy economy or not. So we'll go over those stories. Again, welcome to the Real Estate Investor News Channel. My name is Tony Moreno, your host. And let me start sharing the three stories that we're going to go over today. Today, we got GDP. U.S. economy grows at 1.6% annual pace in the first quarter, falling short of the estimate. At our second story, we have is it a buyer or seller's market? We're going to discuss some markets that are considered to be some sellers markets and some buyers markets. So where should you invest? And the third one, also related to GDP. And again, I go over this because it's very important, especially now since rates are a pretty big thing. I think that's why I'm discussing these pretty big because again, it affects the price that we purchase things, homes the way we finance things. So that's why I've been going over those because right now that is what a lot of people are looking at, including myself. So that's why I'm going over these in the last episodes that I've been discussing. So we'll get right into it. So for our first story, we got GDP came in at 1.6%. Now the goal was 2.5% growth. And if you think of GDP like you can think of it as uh, all the income generated in the US, meaning let's say a company that sells metal, and then you have a doctor that brought in some income. And pretty much all the income that is generated in the US, that is what GDP is. And I actually pull up the Fed economic data here. You notice how every year GDP is increasing, which is good. It went down every recession pretty much. But again, the expectation was 2.5%, but we're super short of that at 1.6. And I say super short because that is pretty significant. And it says here, meanwhile, the core of the CPE, which we discussed, I think it was yesterday, excludes the volatile food and energy, grew by 3.7%. Now, I'm not a math expert and I'm not an economic expert, but when I look at this, if I see that um, the income of the country of the U.S. Went up by 1.6%, and then you see CPE, which is an inflation metric, very big inflation metric, and that went up by 3.7%. Again, I'm not a math guru or anything like that, but you can clearly see where things are falling short. Like basically, are we're losing money. We're losing value. So again, I'm not an expert, but that's what it looks like when I read numbers like this, and that's why I'm discussing numbers like this. I mean, the economy is still not in a great place. But anyways, let's continue reading. It says here the data release comes as investors try to gauge when the Federal Reserve will start cutting interest rates, and if the central bank, which is the Fed, can achieve a soft landing where inflation comes down to the 2% target. Now, I read in another article that maybe this 2% is not going to be reachable. And what they're thinking of, like, not the Fed is thinking, but like, what if the 2% is not achievable anymore? What if we go to like a 3% mark or something like that? I hope we don't get there because that means for a lot of W2 employees like myself, we need, instead of a 3% raise every year, we need something higher than that. And right now, the way inflation happened in the last couple of years, if you did not get a raise higher than 9%, then you're making less money than you did last year, if that makes sense. But anyways, that's for our first story. For our second story, which actually relates to this first story, this is an article that released Thursday, I think it was, and which released right after the GDP release. Um, and it says expect big negative revisions to the BLS monthly jobs in 2023. And BLS is the Bureau of Labor Statistics, if I'm not mistaken. Yesterday, they released a little read job report that shows that reported jobs in 2023 may be wildly overstated. So they said that they generated a whole bunch of jobs, and it looks like that is not the case. So we'll see what that correction will be. Stay tuned on this channel. We'll discuss it whenever that comes out. For 2023, the BED report shows a gross job gains of 7.5 million, and gross job losses of 7.7. So a net loss of 192,000 jobs. Let's see down here. Thus, the BLS says that the BLS monthly job reports for 2023 Q2 and Q3 are overstated by a total of 1.3 million jobs. And again, this is for 2023, but still, uh, I mean, corrections happen all the time. Revisions, better say, happens all the time. So that is definitely going to affect the GDP numbers that I just mentioned in the first story. And man, it's a scary thought, honestly. Um, so, as a takeaway for this story, expect major revisions not only on the annual Bureau of Labor Statistics benchmark revision, but also the GDP. The BED report lent huge credits to the idea that GDP data is overstated and gross domestic income numbers are more accurate. So, we'll see. We'll see how things turn out when this comes out. So, the last story for today I got, is it a buyer or a seller's market? Now, the gauge here, let me kind of remove myself from the camera, or remove the screen from the camera. And the allergies, people, are still killing me. This is I'm telling you, this is whoo, I can barely breathe. So that's why you hear my nose kind of like stuffed up. But anyways, it's this whole week, and I like to drive with my windows down, so that's probably why it's like that. Anyways, so a buyer's market is when buyers have the upper hand, and basically there's not a lot of demand for housing. So buyers can actually put up low offers, and they'll most likely get accepted. Now, seller's market, which is what we've been experiencing since like 2020 when COVID and when the pandemic came, is basically sellers have the upper hand, and we're getting tons of offers when we put our property for sales. So that's the two differences between those. So let's see what this article is saying. On a national level, the housing market continues to favor sellers due to the inventory levels that remain about 40% below pre-pandemic levels, which have helped send median home prices up 6.6% year over year. The first few months of 2024, favorable conditions for the housing market include low unemployment, few mortgage delinquencies or foreclosures, and home builders doing the best to boost the supply. Again, because we don't have that many homes out there. So, again, prices are going to continue to stay up as long as there's not a lot of supply and demand is still high, especially because I think we talked about it yesterday. Rents are still going high and higher and higher. Well, they will start now even more. So, people are going to wanting demand is going to increase. Basically, what I'm trying to say. While many buyers have slowly been accepting the reality of higher interest rates, keeping their fingers crossed to refinance down the road. And over the 12 months ending in February, the median price of homes sold in the U.S. rose about 6.6%, which we already talked about. However, there were a few cooler markets tracked by the U.S. News HMI that noted annual price declines. And I'm scrolling down so you guys can see while I have some sip of my water. I will share the links of this story in the notes. So if you want to look at this at your own time, if you're driving, please don't look at your phone, so you can look at this later. So we can see buyer's market. So places where, again, where you can make a low ball offer, not necessarily super low, maybe, and your offer is most likely to get accepted. We got markets like San Antonio, Texas, Greeley, Colorado, Northport, Florida, which again, I'm shocked that Florida is even there. I mean, I don't know much about Northport, but Florida being a state where a lot of people want to live, Northport is one of the ones where it still is kind of like a buyer's market. Then we have neutral markets, which again is shifting back and forth from a buyer and a seller's market. Is Raleigh, North Carolina, and San Francisco, California. Because really, I mean, some people want to live there still, but still rents or prices are still super high. And right now, overall, the United States is a seller's market, and you see places right here like Cleveland, Ohio, Boston, and Seattle being at the top of the list for sellers markets. So that's where we're at today. Actually, at the bottom of the list. I'm sorry. The top ones are San Diego, San Jose, and Seattle. Those are for the sellers market. So yeah, that's our our three stories for today. So takeaway, again, keep an eye out for GDP for the June numbers. I think I stated that yesterday. Same thing, just keep an eye out to see what the economy is going to do, because that drives what everything is doing. I'll be honest, me personally, I have not been buying and holding rentals, a lot of rentals. This 2024, I'm focusing more on fix and flips for future plans that I have. And because right now it's really hard to find a cash flowing deal. I mostly do bird deals so I can keep my money moving. But it's really hard to find some right now. We still finding them. I mean, last year I got a couple, but it's just more difficult. You have to get very creative with your strategies, with your niche. So yeah, just keep track of what the US economy is doing so you can see what your next move is going to be. If you like what you heard today, please subscribe to our channel, hit the like button, hit the love button. That's how I'm able to grow this channel and keep it free. So yeah, thank you everybody for listening, and you guys have a wonderful rest of your